The S&P 500 and the Nasdaq both posting record closing highs today. Meantime, the 10-year yield fell to its lowest level since February, below 130 earlier in the session. This as big tech stocks continue to soar to new highs. Let's bring in Dan Niles, founder and portfolio manager of the Satori Fund. Great to have you back on the show, Dan.
My pleasure, Sarah.
We got to start with Oracle. It's closing at a record high. This was your one tech pick for 2021. It has been an amazing pick and just out of nowhere has exploded higher. You wish you picked more big cap, big sort of mega cap defensive tech names?
No, I mean, Oracle was our pick. It's done well. Obviously, you and I have talked, for the last several interviews going back a few months about Google and Facebook and how we like them as reopening plays as well. But our top picks have done great this year. Our top 5 are up 27% on average. And, Oracle's done very well. We still like Google and Facebook in tech because they're reopening plays that are growing revenues at 30 to 35% that you can get at a 24 to 25 PE, which is just a point or two above the S&P. And so, we like certain pockets of the market, but, in general, we believe still that rates are going up, and that's going to cause a problem when we get, kind of to Jackson Hole in August. And that's kind of our roadmap. And it's been our roadmap all year, really.
Well, rates are going down. I mean, the 10-year yield today hitting the lowest level since February, back to 129. And your whole thesis of cyclical inflation stocks, that hasn't been working lately. So are you changing the playbook, or you think it's going to be revived?
No, I'm not changing the playbook at all. It's 1 month. I mean, if you look at last month, the materials, industrials, financials, those names were down. Those three sectors, the S&P, were down 2 to 6%. But remember, they were up 18 to 28% or so coming in, through the end of May. And tech stocks within the S&P 500, those were up about 7% after being up only 6% coming into May. So, yeah, there's definitely some rotation going on right now. But, big picture, my view is pretty simple. We still see economies opening up. We see vaccinations going up, herd immunity going up, and the best GDP growth in the United States since the 1980s. And so with that as a backdrop, unless you believe that we're going to shut down again globally, I think you stick with that. And this is a 1 month pullback, and it's not that big a deal. And as I said earlier, there's some tech stocks that benefit from reopening, like Google and Facebook.
And so you alluded to it there in your answer. You're still interested in financials because you do believe that rates will be rising, at least sort of the longer to medium term trend.
Yeah, I mean, that's right, Courtney. I mean, if you go back and you look at the last time the Fed said that inflation was transitory, that was back in 2004, and interest rates were at 1%. They raised rates 17 times over 2 years, which ultimately resulted in the global financial crisis and took rates from 1% to 5.25%. So it wasn't transitory then, and I think if you look at the data today, home prices, best levels in 30 years, wages up 3.6%, which is also another sticky component of inflation. This is going to be just as transitory as it was in 2004, and the Fed's behind the curve, and they're going to have to play catch up. And with valuations at record levels, that's kind of a toxic combination for certain types of stocks that are, long duration assets with high PEs with earnings 10 years into the future.
Shepard Smith here. Thanks for watching CNBC on YouTube.